Okay, hello everyone. Welcome to our today's webinar on diverse trading styles and order types. My name is Ali Mortazavi. I'm the head of training and education at Errante. I'm going to be your guide on this journey through the complex world of Forex trading. And together we will explore the nuances of different trading approaches and master the art of trade execution today. So here you see my agenda. By the end of our session, you will have achieved a robust understanding of the various trading styles, such as day, swing, position, and scalping trading. And we will delve into the particulars of market orders with a special focus on the strategic timing of limit, stop, and stop limit orders. Our journey will also take us through the realm of algorithmic trading and equip you with essential risk management techniques. Through practical application and real-world examples, we will solidify this knowledge, concluding in an interactive Q&A to address your individual queries and deepen our understanding together. So if it sounds good, please let me know if you can hear me and see my presentation clearly so we can proceed further. I would appreciate if you can just give me a confirmation through your chat box. Very good. So let's continue further. Thank you so much. And before we proceed, allow me to introduce Errante. As an online broker, Errante is dedicated to delivering premier services, fostering lasting relationships with clients, and ensuring trust in every interaction. Our commitment is the foundation upon which we build your trading success. And we will be so happy to do that. Please note that the contents we discuss today is for educational purposes only and should not be taken as investment advice in any form. I must emphasize the importance of understanding the risk involved in trading CFDs and other derivatives. These instruments can lead to rapid losses due to leverage, and it's crucial to only trade with funds you can afford to lose and seek independent advice if necessary. Remember, a well-informed trader is a responsible trader. So let's just start our webinar. In our quest for market mastery, we embark on a journey through the diverse landscape of Forex trading styles. As we delve into this realm, we recognize that each style embodies a unique rhythm of market engagement. A trading style is more than a strategy. It's the embodiment of one's philosophy, discipline, and tactical approach to the currency market's ebb and flow. Its importance cannot be overstated as it aligns with one's inner trading temperament. For the rapid-fire decision of scalping to the strategic patience of position trading style, be it day, swing, or position trading, has its distinctive tempo and set of requirements. And this overview serves as a map to navigate the major trading styles, helping you to understand where your natural inclination might find their best fit in the trading world. The real world implications of choosing a trading style are profound. Your selection will determine not just how you trade, but how you analyze the market, manage risk, and ultimately how you achieve success in the Forex market. So as we transition from our broader overview of trading styles, let's zoom in on the first of the four major approaches, which is day trading. Day trading is the ideal style for those who desire to conclude their trades within the span of a single trading day, avoiding the risk of leaving positions open overnight. It's a style characterized by agility, discipline, and a keen sense of market sentiment. Day traders aim to identify and capitalize on price movements that occur within the trading hours of a single day. They seek to join these small fluctuations for potentially quick profits. Uh, it's worth to add that day trading involves a microscopic view of the markets, where time frames range from minutes to hours. However, technical indicators play a crucial role here. Typical setups might include breakout patterns, trend following, or counter trend moves, all requiring precise entry and exit strategies for a day trader. Tools like moving averages, Bollinger Bands, and MACD provide the navigational aids for day traders to chart their course through the daily tides of price action. But let's not forget the backbone of day trading, which is risk management. Effective strategies to manage risk, such as setting tight stop losses and only risking a small percentage of the capital on each trade, are what separate the seasoned day trader from the novice. And to bring the concept to life, let's consider an example. Imagine a typical currency pair exhibiting volatility at the market open. A day trader might use a combination of trend indicators and momentum oscillators to identify an entry point and capture a swift move before the market stabilizes again. So our trader might use the H1 chart to enter a long position on a break above the key resistance level, setting a stop loss just below the breakout point and taking profit at the predetermined resistance level, expecting the price hitting the target within few minutes or few hours. All in all, day trading stands out as a strategy for those who prefer to keep a finger on the pulse of the market, reacting in real time to news, economic data, and price patterns. It's a style that demands focus, fast decision making, and unyielding adherence to disciplined trading rules. So, as we navigate away from the energetic realms of day trading, our next part of call will be the strategic and measured domain of swing trading, a style that allows traders to capture gains over a slightly longer horizon. Swing trading stands in contrast to the immediacy of day trading, offering a dance with the market that spans several days a week. It allows traders to capture larger price movements, potentially yielding more significant profits per trade than day trading. Uh, as you see here, swing trading typically involves analyzing medium-term time frames ranging from daily to weekly charts, allowing for a broader view of market movements. And this perspective enables the identification of more substantial price patterns and trends, which are less visible to day traders' eye. The distinction between swing and day trading styles is profound, not just in the duration of trades, but also in the trader's mindset. While day trading demands constant observance, swing trading requires patience and the fortitude to withstand minor fluctuations in favor of a larger goal. In our toolkit of technical analysis, chart patterns such as flags, pennants, and some patterns like a cup with handle formations become invaluable alongside indicators like the relative strength index, as we know as RSI, and Fibonacci retracements. These tools help in interpreting the market's narrative over a more extended period, providing indication for entry and exit points. In conclusion, swing trading is less about the sprint and more about the marathon, requiring a keen eye for a strategic entry points and a steady hand to maintain positions despite the inevitable ebbs and flows of the market. And now, let us broaden our horizon further to encompass the long-term view of position trading, where the integration of a macroeconomic understanding with technical insights is paramount. So, as you see, position trading is the art of strategic patience, a method that invites us to participate alongside significant trend lines that dictate market direction over months or over years. It's the choice of the visionary trader who looks beyond the horizon of temporary fluctuations to the larger movements shaped by fundamental economic shifts. In practical terms, position traders utilize deep fundamental analysis, examining macroeconomic indicators like GDP, growth rates, interest rate policies, and political stability to predict long-term market direction. They marry this with technical checkpoints, ensuring their charts confirm the story told by the economic data. But even the tallest buildings needs precise blueprints. That's where long-term technical analysis comes into play. Position traders use major trend lines like the arcs of a grand bridge connecting peaks and troughs across a chart's landscape. They also rely on the multi-month support and resistance levels as checkpoints, ensuring they are on the right path. And like a lighthouse guiding ships at night, moving averages signal the direction and the strength of market trends to affirm entry and exit points. Consider, for instance, a currency pair that is poised to benefit from a shift in monetary policy indicated by central bank announcements. A position trader armed with this insight might enter a trade with the expectation that the trend will undergo for several quarters, adjusting their trade management to account for this temporal scope. So the essence of position trading lies in its foundational belief in sustained trends driven by powerful economic forces. It demands a comprehensive understanding of the market's fundamental drivers and a disciplined approach to weather the storms of short-term volatility. And here is the next one, which is a scalping. And scalping is for the swift, where traders capitalize on the smallest of market movements, often within minutes. Scalping is the strategy of choice for those who prefer a high volume of trades, seeking incremental gains that over time can accumulate to substantial earnings. So to execute the scalping strategy effectively, one requires a precise entry and exit plan. Scalpers often rely on short-term price charts, utilizing ticker 1 minute time even, where they scrutinize for quick opportunities as they arise. And scalping setups must be positioned for instant reaction. Traders use real-time price action, laser-focused on level to codes that display market depth, and short-term candlestick patterns to identify the immediate sentiment and direction of the market. It's about capturing the moment like a photographer snaps a fleeting shot. And the infrastructure for scalping must be robust. A trading platform with ultra low latency or real-time data feeds, and the ability to execute orders at lightning speed are not just advantages, but necessities. The scalper's platform must be as swift as a race car. Every millisecond of delay can be the difference between profit and loss. And the need for speed in execution is paramount, ensuring that orders hit the market in the blink of an eye, minimizing the risk of a slippage, which we will explain it later in this webinar. And moreover, the cost of trade is a critical factor. In the scalper's universe, every pip counts. and the gravity of the spreads and commissions pulls heavily on profitability. Hence, the quest for a broker with the lowest cost is not just preference, it's a necessity again. Let's take the USD JPY pair, a highly liquid and popular pair for scalping, to explain the nuances of this trading style. The USD and the Japanese yen are often influenced by different factors, including interest rate differentials, economic data releases, and global risk sentiment. Let's say a scalper would typically start the day by looking at the economic calendar to be aware of any major news releases that could affect volatility and liquidity in the USD JPY pair. They prefer times when there's enough liquidity but also enough volatility to create profitable opportunities and small price changes. For example, when the US market opens, there is often increased volatility and volume in USD JPY due to fresh economic data and the start of the North American trading session. Scalpers might take advantage of this by entering trades based on the initial market reactions to news events, knowing that the USD JPY pair can have quick and sharp movements. And in this scenario, scalpers use technical analysis extensively, relying on tools like candlestick charts or level 2 codes and or order flow to make quick decisions. They may use very short-term indicators such as 1-minute moving averages, stochastic oscillators, or pivot points to find entry and exit points that align with micro momentum shifts in the market. So, as a practical example, let's imagine the USD JPY is trading in a tight range with a clear support and resistance level. A scalper might set up to buy near the support level and sell near the resistance level, expecting the price to bounce back and forth within the range. So since you're looking for small moves, even a few pips movement towards the anticipated direction could be considered a successful outcome for a scalper. And the scalper must be disciplined in their exit strategy, because a few bad trades with losses larger than the small gains can quickly erase all profits. Therefore, they often have very tight stop losses and predetermined take profit levels. If the USD JPY moves even a few pips against their position, they will likely exit the trade immediately to keep losses small. So, given the necessity for rapid execution, scalpers usually benefit from automated trading platforms that can execute trades within milliseconds of spotting an opportunity. Additionally, because spreads can eat into the thin profits made on each trade, they typically operate on accounts with very low spreads and commissions. So in a sense, scalping is not merely a trading style, it's a disciplined practice that operates on the edge of market movements, binding the volatility of the Forex market in its most minute expressions. So let's move on to the next section, which is understanding the basic elements of trading styles, begins with self-assessment. As we delve into the fabric of what constitutes the trader's identity, it's imperative to align one's inner compass with the market's rhythmic pulsations. So each trader embarks on a journey that is as unique as their fingerprint. Your trading journey is no different. It requires a profound understanding of your own personality. Are you the kind of person who remains unruffled by the market's ebbs and flows with a systematic approach to the tick of every chart? Or do you find your pulse quickening with each market fluctuation, eager to ride the waves of immediate decision making? It's this introspection that will curve the path to your trading style. Also, time is a resource just as critical as your capital. Evaluate earnestly how you can weave trading into the tapestry of your life. Is it to be the main act or a side performance? Your time availability is the cornerstone of your trading structure. In sum, the first step to the mixture of trading is incomplete without the stones of risk tolerance and time commitment. As you ponder these questions, let them be the guiding stars towards the trading style that echoes your personal truth. Now that we have peered inward, let's project our gaze outward to the tangible goals and the life you lead outside the trading screens. Envision your financial aspirations. Is your quest geared toward the consistent currents of income to fund your lifestyle, or is it the promise of a long-term wealth accumulation that fuels your trading dreams? The answers lie in setting clear, defined goals that resonate with your financial aspirations. Your trading style should be a harmonious extension of your life, not a discordant note. It must fit into your daily time, complementing rather than disrupting, ensuring that the pursuit of market success doesn't come at the expense of personal well-being. Because eventually you need to uh, let's get profits in the market, and to get there you need a really successful mindset. Uh, so your financial goals and lifestyle are not just related, they are the bedrock upon which your trading style is built. So choose a path that sustains your spirit as well as your wallet. With your goal set and your personality in mind, we turn to the canvas of time frames, each with its own palettes of opportunities and constraints. Let's start with day trading. Is the a sprinter's choice, perfect for those with the agility to respond to the market's rapid fire changes within minutes to hours. It's a full-time commitment, demanding your undivided attention but rewarding with the potential for swift gains. Then we have swing trading, as we explained, which offers a middle ground, a rhythmic dance for those who can spare a few moments throughout the week to catch the market swing from day to weeks. It's less about the sprints and more about the marathon strides. And then we have precision trading, which is the domain of the strategist playing a long game, analyzing the market's fundamental undercurrents over months or years. And it's a trading style that requires patience, akin to planting a seed and watching it grow. And then you see here is scalping. Scalping is for those with the focus of the hawk, ready to jump on small price changes. It's a high octane challenge on the 1 minute to 15-minute charts, where success is measured in takes and time is measured in breadth. In conclusion, your trading style and time frame should be in sync, resonating with your personal rhythm and the market's tempo. It's a partnership where time is your ally, not your adversary. Cool. Perfect. And here are some tips for the part-time trader. The intersection of time frames and trading opportunities is a balancing act requiring a keen sense of timing and self-awareness. Longer time frames, which serve a less demanding presence, a gentler approach that allows for life's other commitments to flourish alongside your trading endeavors, and they offer a forgiving space for those who juggle multiple roles. Yet, the allure of shorter frames uh, lies in their abundance of opportunities. They become the trader with the promise of frequent trades, but demand attributes of time and unyielding focus. So the part-time trader must weigh the scales of time and opportunity, seeking equilibrium. Choose the path that offers peace, not pressure, allowing you to savor both your trades and your life outside the markets. So the journey to selecting a trading style that resonates with your persona is not just about preference, but about strategy and practicality as well. Let's delve into the practical steps that can guide you through this pivotal decision. Imagine having a sandbox where you can mold and remold your strategies without the fear of loss. A demo account offers this safe haven. It's the proving ground for your theories. Here, you can acquaint yourself with the nuances of different trading styles, from scalping to position trading. You can try all of these styles together, and the aim is to discover a style that not only yields profitability but also sits comfortably within your psychological boundaries. So my suggestion is you should start with demo accounts if you are so new to trading world. And as you navigate through the markets, your trade journal becomes the chronicle of your trading journey. It's an unvarnished record of what strategies worked, what didn't, and most importantly, how you reacted in different scenarios. Patterns will emerge later, patterns that tell the story of which trading styles you are most attuned to. This reflective process is invaluable. It will illuminate the path to a trading style that aligns with your strength and compensates for your weaknesses. And then BC, continuously educate yourself. The landscape of Forex trading is ever shifting, with new strategies emerging as quickly as old ones become obsolete. To stay ahead, your education must never cease. Embrace learning with vigor, attend webinars, read extensively, engage with other traders, and this constant enrichment of knowledge and skills will equip you to adapt your trading style to evolving market conditions and personal growth. And then please consider how much time you can dedicate to trading. Time is a resource just as critical as your capital. Assess the hours you can devote to trading with uh, unflinching honesty. Well, can you immerse yourself in the market full time? Or are you seeking to weave trading into a tapestry of other commitments? Your availability will dictate whether you can engage in the hands-on approach of day trading, or if you should gravitate towards the less time-intensive methods like swing or position trading. Conclusion is that choosing a trading style is a pivotal decision, one that shapes your trading journey. It's a fusion of self-awareness, strategic thinking, and practicality. Start with a risk-free exploration in a demo environment, critically analyze your performance, arm yourself with knowledge, and be realistic about the time you can invest. Through this process, you will find the trading style that not only suits your goals, but also complements your life. Embarking on our journey through the digital landscape of Forex market, we encountered the sophisticated world of algorithmic trading system. This is where strategy is encoded into algorithms, allowing traders to engage with the market at unparalleled speeds and with a remarkable volume. Algorithmic trading, a pinnacle of trading evolution, leverages mathematical models to execute trades automatically based on predefined criteria. This method streamlines the trading process, enabling strategies that can react to market changes in milliseconds. There is a constellation of algorithmic strategies at our disposal. Trend following algorithms, for instance, are programs to detect and follow market momentum. Mean reversion algorithms and capitalize on the tendency of prices to revert to the mean over time, and statistical arbitrage algorithms seek out price discrepancies across similar instruments, exploiting these for profits before the market corrects itself. And not to be overlooked, high frequency trading algorithms, or HFT, operate at near light speeds, conducting a vast number of transactions to capture fleeting price movements. The bedrock of these sophisticated systems is backtesting. This is the rigorous simulation of how a strategy would have performed using historical market data. Backtesting in MT4, for example, allows traders to evaluate the effectiveness of their algorithms by replaying past price movements and recording the trading outcomes. This process is essential. It's very important where theoretical strategies are tested against the harsh realities of historical market behavior. And in that case, you will get a clue that if your developed strategy is working properly, or it needs more amendment. The back test on MT4, one would typically assess the strategy tester. This is a feature that you can select the desired algorithm, historical data, and time frame, then initiate the test to observe the algorithm's decisions as if they were made in real time. So this practice is not just instructive, but also a critical risk management tool, helping to refine strategies before they encounter live market conditions. Yet, we must acknowledge the dual-edged nature of algorithms. It's really important, guys. On the one hand, it offers the advantages of dispassionate precision, the ability to process complex calculations, and the capacity to exploit quick market opportunities. On the other hand, it's not without limitations. Algorithms lack the human trader's intuitive understanding of market nuances, and they require constant monitoring to ensure their relevance and as market conditions evolve. So in some, algorithmic trading systems present a compelling avenue for those inclined towards technical and analytical rigor. They stand as powerful tools in the Forex traders' arsenal, provided we respect their capabilities and recognize the need for continual oversight and adaptation. Yeah, let's move to the next slide. As we delve deeper into the mechanics of forex trading, we now turn our focus to market orders, a fundamental tool for traders seeking immediate entry or exit in the market. The market order is the most basic and frequently used order type, instructing the broker to execute the trade instantly at the best available current price. It's the essential order for traders who prioritize speed and certainty of execution over price control. In practice, a trader might use a market order when they agree that immediate action is more valuable than waiting for a potential price improvement. For example, upon the release of significant economic news that is likely to impact currency prices, a trader may choose to enter the market swiftly to capitalize on the anticipated volatility or to exit to avoid potential losses. However, it's crucial to understand the phenomenon of slippage. Sorry. However, it's crucial to understand the phenomenon of slippage, which uh, occurs when there is a difference between the expected price of a trade and the price at which the trade is actually executed. A slippage is common in fast-moving markets like the moment of news announcements or periods of low liquidity, like the beginning of or ending hours of a trading session, when currency prices can change rapidly before the execution of a market order. Uh, so, to mitigate the slippage, traders can adopt several practices. One of them is using pending orders instead of market orders when entering positions can cap the maximum price paid or minimum price received. Additionally, staying aware of market conditions and timing trades during periods of higher liquidity, avoiding major news events, for example, when volatility spikes, can also reduce the likelihood of slippage. By the way, it's imperative for traders. Yeah, it's imperative. I see, guys. Sorry, I got some notes that some of our audiences can't see our screen. Would you please confirm it to me if the issue has been fixed now? Okay, very good. Thank you so much for your feedback. So let's continue. I was saying it's imperative for traders to recognize that while market orders provide the certainty of execution, they come with the inherent risk of a slippage. By strategically choosing when to place a market order and by understanding the market conditions that contribute to a slippage, traders can navigate this risk with greater control and proficiency. Okay, armed with this knowledge, we progress to the strategic deployments of limit orders. These orders not only provide us with greater command over our entry and exit prices, but also serve as a critical component in our risk management toolkit. A limit order is a commitment to the future, a decision made in the present to take action when the market reaches a price you have determined to be significant. This is where strategy merges with execution. In the tactical play of forex trading, two particular types of limit orders come to the forefront: the buy limit and the sell limit order. So let's see what is a buy limit order. A buy limit order placed below the current market price is a trader's way of saying if the price drops to this level, for example, it is advantageous for me to enter a long position. It's a predetermination to buy at a bargain. Conversely, a sell limit order is positioned above the current market price, signifying a trader's intent to take profits or initiate a short position at an optimal price point, effectively saying, if the market reaches this high, I shall sell worth the mention. That's yes. Sorry, I got another notification from one of our audiences that they can see our screen very well. I appreciate, guys, if you can confirm for me that you can see my screen, then uh, I will be able to continue. Okay, the issue fixed. Great, great. Okay, let's go. I was saying, conversely, a sell limit order is positioned above the current market price, signifying a trader's intent to take profits or initiate a short position at an optimal price point, effectively saying, if the market reaches, for example, this high, I shall sell. Worth to mention that buy limit order is executed when the ask price hits the buy limit price here, and sell limit order is executed when the bid price reaches the sell limit price. So let's paint a scenario here. You've analyzed the GBP USD pair, currently priced at 1.3. Your analysis suggests that if it dips to 1.2950, it will likely ascend again. By setting a buy limit order at 1.2950, you are poised to buy at a discount relative to the current price. Your position will be triggered if the ask price falls to this predetermined limit price. Similarly, if you believe the price will climb to 1.3050 before descending, placing a sell limit order at 1.3050 positions you to sell at a premium, and your position will be executed if the bid price reaches the predetermined sell limit price. So let's see, how do these orders weave into your strategies? For a trend follower, a buy limit order can be set at a pullback to a moving average or banking on the trend's continuation. For the contrarian eyeing a mean reversion, a sell limit order at a historical resistance level can capitalize on the market's propensity to reverse from such established zones. In conclusion, embracing limit orders means engaging with the market on your own terms, allowing you to execute trades within the boundaries of your strategic planning. It's a disciplined approach to entering and exiting positions, one that every trader should harness to align their execution with their market vision. So let's move forward. After having established the strategic merit of limit orders, we shall now turn to stop orders. These orders are not merely safety nets, they are crucial instruments in the trader's risk management symphony, allowing us to limit losses and to protect profits against the unpredictable tides of the Forex market. A stop order is placed to buy or sell a currency pair at the market price. Once your specified price, the stop price, is hit, it's a transition It's a transition point where the stop order converts into a market order. And this shift is crucial in both entering positions at breakout points and in capping potential losses. Okay, it's important to note that all the features we discussed about market orders are applied to stop orders as well. So delving deeper, we distinguish between two types of stop orders. As you have already seen, a buy stop order is typically placed above the current market price, which is very important to note. So a buy stop order placed above the current market price and springs into action if the ask price ascends to that level, often used to enter a trade in anticipation of a bullish breakout. On the other side, a sell stop order is set below the current market price, triggering a sale if the bid price falls to that level, commonly employed to either initiate a short position or to exit a long position defensively. Imagine you are monitoring the USD JPY pair, which is currently trading at 110. You assume that if it breaks above 110.5, it will continue to climb. Here, placing a buy stop order at 110.5 positions you to catch the upward trend. Conversely, if you hold a long position and want to limit potential losses, setting a sell stop order at some lower price, assume 109.5, ensures you exit the trade before the market can move further against you. So this is how you can use the stop orders in your trading. Stop orders are the pillar of prudent trade management. They provide a methodical approach to defining exit points on open positions, serving as a pre-planned strategy to either look into the potential profits or to prevent excessive losses. This automated approach removes emotional decision making from the equation, so adhering strictly to the risk parameters set by the trader. In conclusion, stop orders are the guardians of your trading discipline. They help to enforce the rules of your trading strategy, automatically executing crucial decisions that align with your risk tolerance and profit objectives. Now, with a clear understanding of limit orders and stop orders and their role in fortifying our trading strategies against market volatility, we will next explore stop limit orders. Stop limit orders are a type of orders used in trading to buy or sell a security once its price moves past a specified point, ensuring a higher probability of achieving a predetermined entry or exit price, limiting the trader's loss or locking in profit. Once the price crosses the specified stop level, the stop limit order becomes a limit order, not a market order. There are two types of stop limit orders: buy stop limit orders and sell stop limit orders. A buy stop limit order is placed above the current market price. It consists of two prices: the stop price, which will convert the order to a buy limit order, and the limit price. Once the stop price is reached, the buy limit order is activated, but will only be executed at the limit price or higher. This type of order helps traders control the price they pay once the stop price is triggered. In other words, as soon as the future ask price reaches the stop level indicated in the order's the price field, a buy limit order will be placed at the level specified in the stop limit price field. A stop level is set above the current ask price, while stop limit price is set below the stop level. Conversely, we have a sell stop limit order as well, which is placed below the current market price. It also involves a stop price and a limit price, and is used to limit a loss or protect the profit on a security that you own. When the stop price is reached by the bid price, the sell limit order is activated, but it will only be executed at the limit price or lower. In other words, this type is a stop order for placing sell limits. As soon as the future bid price reaches the stop level indicated in the order as the price, a sell limit order will be placed at the level specified in stop limit price field. A stop level is set below the current bid price, while stop limit price is set above the stop level. The stop price is the trigger that converts the stop limit order into a limit order. So the limit price ensures that the order will not be executed unless it can be filled within a predetermined price range. And also, these orders are a way to have more control over where the order should be filled, potentially avoiding the pitfalls of slippage, especially in fast-moving markets. However, there is no guarantee that the order will be filled, especially in a rapidly falling or rising market where the price surpasses the limit price and stop price and doesn't come back. So the stop limit orders can be very useful, but they require understanding and precision to use effectively. They are best used when you have a clear strategy for entry and exit points in a trade, and when you are unable to monitor the market continuously. Uh, as we progress in our exploration of the Forex markets journey, we approach the sophisticated rhythm of advanced order types. These are the tools for the seasoned trader. It's designed to serve specific strategic functions within diverse trading arsenal. These advanced orders enable traders to implement complex strategies with precision, offering nuance, control over their trades, and allowing them to navigate the market's volatility with foresight and agility. So let's begin with OCO, or one cancels the other orders. An OCO order is essentially a pair of orders linking two entry points, a stop and a limit order, for say. When one is executed, the other is automatically canceled. This dualistic nature of OC orders makes them invaluable for situations where a trader must prepare for multiple potential market directions. Consider the Euro-USD pair with a current level of 1.18, anticipating volatility. You place an OCO order, a buy limit at 1.1750 and a sell limit at 1.1850. If the price drops to 1.1750, your buy order is triggered, buying at the lower price, while the sell order is cancelled automatically. Should the price instead climb to 1.1850, your sell order is activated, selling at a higher price, and the buy order is nullified. Next, we examine trailing stop orders. These orders are designed to protect profits by enabling a stop loss order to move with the market price. As the price moves in favor of the trade, the trailing stop moves by specified distance, locking in profits dynamically. Imagine you are in a long position on USD JPY at 150 with a trailing stop set at 10 pips. If the price moves to 150.15, your trailing stop rises to 150.05, securing a portion of your unrealized gains. If the price then reverses, the trailing stop ensures you exit the trade profitably. safeguarding your earnings from the new high. And then we have GTC, or good till cancelled orders. These orders remain active until the trader decides to cancel them. They are the essence of set and forget trading, allowing traders to enforce their strategy over an extended period without needing to reset orders daily. For instance, if you analyze that GBP/USD will hit a resistance level at 1.23 and wish to sell when it reaches that point, a GTC sell limit order at 1.23 means your order stays in place until it's executed or you choose to cancel it, irrespective of the session or the day. And lastly, we explore conditional orders. These orders are contingent upon a set of user-defined conditions being met beyond the basic price triggers. They offer a high level of customization and can be tailored to complex market hypotheses. A trader might set a conditional order to buy AUD/USD if it breaks above a resistance level, but only if the RSI oscillator at that moment reaches a certain level to suggest a strong breakout. Such an order waits patiently for both the price trigger and the volume condition or RSI condition to be satisfied before execution. So, in conclusion, I would say each of these advanced order types plays a distinctive role in the crafting of an adaptable and comprehensive trading strategy. They provide the trader with a suite of options to align their market engagement with their analysis, risk tolerance, and strategic intent. So let's us focus on the dynamic tool that can significantly enhance our trading discipline, which is trailing stop loss order. This mechanism is not just a protective measure, it's a strategic ally in our pursuit of profitable trading. It adapts to the market's ebb and flow, safeguarding our gains while providing the flexibility needed for our trades to flourish. At its core, the trailing stop loss is a movable barrier, one that follows your trade's price movement to lock in profits while capping potential losses. Here is how it functions. You set a specific distance, either in pips or as a percentage from the current price level. As your trade progresses favorably, the stop loss trades behind, moving in tandem with the price, always maintaining the preset distance, and it's a vigilant guardian that pauses whenever the market turns against your position, ready to exit the trade if the reversal reaches the defined threshold. The benefit of using a trailing stop loss are multifold. It instills a disciplined approach by allowing profits to run and cutting losses without the interference of human emotion. Imagine setting your trade and knowing that it has the freedom to grow while being protected from a downturn. It's an approach that caters to the set and forget philosophy, reducing the need for constant market surveillance. Moreover, it embodies a dynamic trade management style, ensuring that we are not leaving money on the table during strong trends. Despite its merits, it's important to note that trailing stop loss is not without its limitations. It's vulnerable to abrupt market gaps that can occur during high impact news events or market openings, which can result in trades closing at levels beyond the set stop loss. Additionally, during periods of regular but uh, uh, let's say the very high volatility, a trailing stop loss might exit the trade prematurely, uh, so foregoing potential profits. It's also imperative to be aware of the broker's execution capabilities, as delayed execution can affect the efficiency of the stop loss order. To harness the full potential of the trailing stop loss orders, there are best practices to observe. Employ them in markets with a clear direction where their dynamic nature can truly shine. Set the stop at a distance that mitigates the risk of market noise, yet allows enough room for the trade to breathe. It's crucial to enter the market with a profit target, while the trailing stop loss works to preserve a portion of those unrealized gains. Also, let's consider a practical scenario with the Euro USD pair. Suppose you enter a long position at 1.12 and place a trailing stop loss 20 pips below at 1.1180. As the Euro USD price climbs to 1.1220, your trailing stop loss ascends to 1.12, securing a break-even point. If a reversal occurs and the price hits 1.12, the stop loss is activated and the trade is closed, effectively protecting your position from turning into a loss. So in a sense, the trailing stop loss is a testament to the intelligent application of automated risk controls. It represents a strategic convergence of profit protection and market adaptability. As traders, our goal is to employ such tools and ensuring that they align with our overall trading strategy and market outlook. Okay, let's clarify the availability of these advanced order types in the popular trading platforms that we have right now in Errante, uh, which are MT4, MT5, and also discuss their integration into trading robots. And also the C-Trader, yes. Okay, MetaTrader 4, MetaTrader 5, and C-Trader platform do not natively support OCO orders. However, traders often use scripts or expert advisors to mimic the functionality of OCO orders. An AI can monitor open orders and close one when the order is triggered. But when it comes to trailing stop loss, all MT4, MT5, and C-Trader support trailing stops natively, and traders can set trailing stops on their platform, which then adjust the stop loss order as the market moves in favor of the position. And about the GTC orders, by default, all pending orders in MT4, MT5, and C-Trader are good till canceled, meaning they remain active unless the trader sets the expiration time, or they are executed or manually canceled by the trader. About the conditional orders, as defined by user-specific criteria beyond price, like volume conditions or the other oscillators conditions, are not standard in MT4 and MT5. However, traders can create these conditions through EAs or expert advisors that can monitor various market parameters and execute trades based on those complex conditions. CTrader provides more advanced order types and better out-of-the-box support for conditional orders. Traders can set up orders based on a wider array of conditions without the need for additional programming. So this is an advantage for CTrader. Let's just jump on the integration into trading robots. It's worth to mention that trading robots, also known as expert advisors in MetaTrader or CBOTs in CTrader, can be programmed to include advanced order types even if they are not natively supported by the platform. This programming involves creating custom algorithms that monitor the market conditions and execute trades based on the logic provided by the trader. For instance, an AI could be programmed to place an OCO order arrangement by monitoring two separate orders and canceling one when the other is executed. And trailing stop logic can be also customized in EAs or CBOTs to follow more complex rules than the standard trailing stop features allows. Conditional orders can be also coded to incorporate various market indicators, news filters, volume analysis, or even time-based conditions. In conclusion, while MT4 and MT5 may not support all advanced order types directly, their capabilities can be extended through EAs. CTraders offers more sophisticated order types out of the box. By the way, in all cases, these features can be integrated into trading robots to automate complex trading strategies based on specific criteria set by the trader. So in Forex trading, the seamless integration of trading styles with appropriate order types is not merely beneficial, it's the cornerstone of adept market participation. The confluence of these elements dictates the rhythm of trade execution, each style dancing to the beat of its corresponding orders. Each trading style has its rhythm, so its unique pace and timing within the market's ebb and flow. And it's really important to be aware of all of those styles because let's say, as the trader knows that the key to optimization lies in matching each style with its ideal order types, akin to selecting the right instrument to play a particular piece of music. Okay, let's go through the day trading. Day trading is the sprinter of trading styles, as we explained earlier, fast-paced and focused on the day's race. Market orders provide the instant action needed, while stop orders offer a safety net, swiftly activating a trade when a certain price level is hit. For instance, a day trader observing a range-bound Euro-USD might place a stop order just above resistance and below support, capturing quick profits and small breakouts. In an uptrend, the stop order to buy above a recent high ensures participation in the momentum, whereas in a downtrend, a stop order to sell below a recent low can exploit the downward thrust. Then let's see how swing trading can be matched with limits and GTC orders. Swing trading is similar to a long distance runner, enduring through ups and downs over a longer track. Limit orders allow entry at predetermined levels of support and resistance, while GTC orders maintain these instructions over several sessions. Then a swing trader might use a buy limit order to enter a long position on USD JPY during an uptrend when the price retraces to a moving average support. In a downtrend, the same trader could use a sell limit order to bounce back to a moving average resistance. Both orders could be set as GTC to persist until triggered or cancelled. And as you see, position trading is the marathoner with a strategic view over extensive terrains and time scales. Conditional orders allow the position trader to set nuanced criteria for entry and exit, aligning with comprehensive market analysis. And then see let's say how scalping trading and the order types can be matched. Scalping is a rapid fire action shooter of trading where success is measured in seconds and the smallest of price movements. Here, the market order is king, allowing scalpers to get in and out with speed and precision. In a highly liquid market, a scalper might use market orders to take advantage of the 5-pip movement on AUD/USD, entering and exiting within moments as the price ticks up and down within a tight range. So in a trendless or sideways market, the adept use of limit orders as the ranges bounds can harvest gains from the market's rhythmic oscillations, buying low and selling high repeatedly. Yeah, this is the one way also that we can consider. Uh, and moreover, for the trend followers, trailing stop loss orders are the preferred companions moving in sync with the market and securing profits as trends develop. For the contrarian, buy limit orders near support in uptrends and sell limit orders near resistance in downtrends allow for taking advantage of potential reversals. So this harmonious alignment of styles and orders is not just a method, it's an expression of a trader's philosophy and approach to the markets. By mastering this alignment, traders can apply their strategies with precision and grace. So with a deeper understanding of the advanced order types and their strategic applications, we will now transition to analyzing how these tools can be integrated into comprehensive risk management practices, ensuring that our trading approach is robust, resilient, and responsive to the market's ebbs and flows. Let's start with the stop loss order, which serves as an essential guardrail, predefined exit point of the trade that restrains further losses if the market moves against our position. It's a commitment to cut losses as explained before at a certain price level, thereby injecting discipline into our trading strategy. The placement of a stop loss is typically based on technical analysis, such as a percentage from the entry point, a specific number of pips, or relevant chart levels like support and resistance. By the way, the stop loss must align with the trader's overall risk tolerance and the specific risk-reward ratio of the trading plan. For active trading styles like day trading, stop loss orders may be adjusted as the trade progresses to lock in profits or reduce potential losses. And then you have a take profit orders, uh, which are this type of order is akin to the stop losses young. It's where we define the upper threshold of our desired gain by setting a take profit level. We preemptively establish the point of satisfaction with the earnings from a trade. The level is often set based on the expected movement of the currency pair derived from historical data or current market trends or key technical indicators like Fibonacci projections. For swing and position traders, the take profit may be placed at a significant technical level based on a projected target using price patterns. There is also some psychological benefit. This order type also helps traders avoid the emotional pitfalls of greed by sticking to a predetermined exit plan when the profit objective is reached. And another important, let's say, cornerstone of risk management where we can use all of these trading styles and order types is the portfolio level risk management. Let's explain the diversification. Beyond individual trades, diversification is the strategic approach to spread risk across various currency pairs, financial instruments, or even trading styles to avoid excessive exposure to a single source of risk. The mechanics of diversification. Traders can manage risk by not concentrating in a single currency pair, especially those with high correlation. And also incorporating different asset classes like commodities or indices can provide a hedge against Forex market volatility. If you remember, we explained some of these features in a very great angle of details in our previous webinar that you can just find a link to watch this webinar on our website. Okay, as we draw closer to the conclusion of our session, I invite you to ask any questions you may have. Please not hesitate, and no questions too small or too complex, and this is your opportunity to clarify your doubts and expand your understanding. So if you have any question, please just write it down to me through your chat box. Okay, our time together may be ending, but our journey in the Forex market continues. I thank you wholeheartedly for your active participation and insightful, excuse me, and insightful contributions. Stay tuned for more webinars where we will continue to explore the depths of Forex trading. Thank you and have a great evening.